you put out this report. It's a two-part series, the quote-unquote recoveries and the not just shelter ins. Break it down for us, I guess, starting with the recoveries. What do you like in terms of being able to play the recovery from a tech standpoint?
Yeah, I think, in the recovery names, when you think about travel, ride share, and essentially experiences that people are going to have as they reopen, we think a lot of these names have already priced in pretty large 2022 recovery scenarios, bookings in travel, et cetera. So the way I like to play it is the dark horse play around Alphabet, Google, because 10 to 15% of search is actually associated with travel. And so the extent to which the online travel agencies like Booking, Expedia, and the hotels want to get people on their sites, they're going to be spending money on paid search now. So I like Alphabet as a dark horse travel recovery. And then Uber. About over 55% of Uber's rideshare business is associated with going out, restaurants, bars, traveling, going to airports, et cetera. And so as the world reopens, we think Uber's rideshare business is also going to really reopen. So from a recovery perspective, I'm selective, essentially liking Alphabet and Uber the most.
Why Uber and not Lyft? And I ask that because I realize Lyft is more of a North American story, Uber's more global, but you are seeing some of these employee or I guess contract worker regulations take shape in other key markets like the UK, for example, where Uber specifically is concerned.
Yeah, and the headlines and the debate around global regulation of the shared economy are not going to go away, and I wouldn't even say long term they're necessarily be gone from the United States. So I wouldn't say Lyft is immune from those discussions over the next 2-3 years. Now the reason I like Uber more is because big picture, I like the platforms that have multiple products, so rides, eats, grocery delivery, alcohol delivery, pharmacy delivery, to drive more user frequency and more engagement. And I also really like Uber's focus on building out a subscription business, because the more Uber Pass subscribers you have in the ecosystem, the more likely you are to build a really sticky user base that, in my opinion, is just going to lead to larger overall bookings across the whole ecosystem, more free cash flow, and actually long-term potentially make it more difficult for Lyft to compete against Uber, given Lyft's single product focus.
Brian, on Amazon, I know you've talked about the market being focused on comping the comp, to use your words. I'm curious if you could talk a bit about that, and also what would it take to get to your bull case of 5K?
Yeah, good morning, Carl. Yeah, so comping the comp has been the discussion on Amazon for the last 6 months, where the investors are concerned about the slope of the deceleration in U.S. consumer expenditure on Amazon as the world reopens. And the way I think about it is, when we look at Prime subscribers, we think Amazon added a record number of Prime subscribers last year. Our analysis shows that Prime subscribers actually age incredibly well from year 1 to year 2, year 3. You spend more, you shop across more categories. And so I'm not as concerned about a steep deceleration down to single-digit growth or a decline in expenditure on Amazon. I would just look at your own credit cards, your own credit card bills the next few months, and see if your spend on Amazon actually declines year on year. I'll take the over and say it grows double digits. Now, if Amazon is able to grow U.S. consumer expenditure double digits this year, we see a lot of paths toward $100 billion plus of free cash flow in 2022. And Amazon historically trades around 21 times free cash flow. The extent to which you get $100 billion, that's $4,200 a share.
Yeah.
If expenditure is actually does not slow down as much as we think, or if they have more leverage than we expect in the model, given how big they're getting, that's how you get to the $4,500, $4,800, or $5,000 a share 12 to 18 months from now.
Shepard Smith here. Thanks for watching CNBC on YouTube.